It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me today, yes, it's the man himself, Mr. Michael Becker, for showing on his own show. It should be the Michael Becker Show. That's what it should be. Michael, how
I
are
think so
you?
too. Yeah, we should change the title.
We need to
Yeah,
change the title.
doing good, Paul. Doing good, Paul. It's been a little while since we had a podcast. Wish I was traveling and doing some fun stuff. Just been absolutely slammed working through a bunch of stuff, trying to get some acquisitions teed up and get some stuff on the board. So looking forward to finishing out the year with a flurry of activity. Hopefully.
Yeah, you,
How's everything going in your world? I know you've had recent launch of the Old Capital Accelerator, and I know the Old Capital Conference is coming up. So I know you've been in the lab behind the scenes working on a bunch of stuff. What's been kind of the feedback on the accelerator program?
just like the mad scientist, I'm in the back pulling the chains and pulling the levers, going back and forth. We've had a lot of success with the Old Capital Accelerator program. Again, if you're not familiar with the Old Capital Accelerator program, it's kind of a new thing that we're going to do on a full time basis. You know, for the last couple of years, we've been doing bus tours just to bring people that may not be familiar with investing in apartments for like I don't know, it was $100 or so. Get on a bus, and then we'll show you a little bit about what's going on. We'll teach you for the first half of the day, then get you on the bus in the afternoon. We'll show you a bunch of deals that we've either financed or are available for sale, and people just loved it. And we kind of left them with wetted lips, but we never really could follow through because again, we're bankers by trade, and we're not giving that up. But we've kind of expanded this bus tour into kind of a cohort, and we're only going to have limited people in there, and it's really going to be like an education program, but it's for multifamily specific, but it's a non-denominational program. And Mike, being a believer, what does non-denominational mean in multifamily?
I'm not quite sure, but maybe not beholden to any broker or any mentoring educational group, something like that. Is that what you're meaning?
Yeah, to a certain extent, is that it's meaning that we're not trying to get you to invest in a deal that I control or you control. It is because I'm not a multifamily operator. I'm a banker by trade. My loyalty is to you to make sure that you understand how apartment investing works, all the good, the bad, and for the last year or two or three, it's been the ugly. So what it's not is a one-dimensional program that we only support one general partner. We want to make sure that you understand how these transactions work. And so we kind of pull the curtain back so you can really see what's going on. We're not going to be beholden to anybody. So it's really a non-denominational, and there's not a lot of non-denominational companies out there that will educate you to make sure that you're doing it right. They may only teach you how they can make money in the deal, but we're not going to do that. The program is that we teach you exactly what's going on because we do so many loans in the marketplace that we thought our experience of, again, James has been doing it for a long period of time, and I've been doing it for 40 years, that you could use that experience and knowledge to exactly how these deals work. So again, go, if you're interested, oldcapitalacceleratorprogram.com, oldcapitalaccelerator.com. Join us on the next cohort. It's coming up here soon. And join us. And of course, just what Michael said, Old Capital Conference is coming up, and we'd love to see you in the Grapevine, Dallas, Texas area for that. That's always a great one. So, Michael, Ask Mike Mondays. So today, we're coming into September shortly, hottest time in the month. And I really want to kind of find out, it's hot outside, but is the market hot for us, for the people that are investing in apartments? Who's making the selling decisions these days? Is it the sponsor or the lender? What are you seeing out there?
Oh, sorry, very disparate. It's all over the map, and I think that's obviously one of the first things we want to. My phone rings with the broker saying on market, off market, whatever. Look at this deal, and one of the first things we've been focused on for the last year or two is like, what's the likelihood of the seller actually selling? Paul, am I just going to go look at this thing and waste my time? And seller has unrealistic expectations or can't sell because they need a certain loan amount to clear their debt and their accounts payables, and that pricing is not in line with what the market reality is, and the market valuation is lower than that, and brokers been wasting their time. So that's been going on for a couple years probably at this point. And now I think, to your point, you're starting to see, specifically in the older workforce housing space, to be specific, those deals that were, kind of bought at the peak in 21, 22, the bid can's been kicked a couple times, or, they're at the end of the road, and the sponsors, in a lot of cases, sponsors not in control, and you're talking with the lender. These lenders were for the longest time holding line, like, hey, we need to get, no discount, we need full par, to then, hey, we need par, we need a loan amount, but we'll give you a 90% accretive financing, to now I'm taking a loss, so equity's wiped in a lot of these cases, and the lender is now taking a discounted payoff, or they have already foreclosed and they're going to sell at a loss to their debt basis. So really understanding who's got control of it and is a lender driving the sale. That's what you're seeing a lot in the workforce housing space. You're not really seeing that in the nicer Class A merchant built stuff. You are seeing, we did get awarded a deal the other day, and it's a merchant builder, and the merchant builder is losing money, but it's certainly well above debt basis. So, they've been in the deal for 4 or 5 years and losing money. So it's a terrible outcome for all people involved. But, they're not, it's not like they were, over leveraged and below the lender's basis, Paul.
I may ask a dumb question, but what is a merchant builder? What does that mean?
So, you have kind of build to hold, or you have merchant builder. So, kind of build to hold, long term holds, like a lot of your REITs, your Camdens or MAA, they'll go out, they'll, find a piece of land and get it, the permit, build a property, and they put it in their REIT, and they tend to own and operate it for the next, 10 to 20 years. That's kind of, a lot of what like the REITs do. Most of the product, certainly in Texas, is built on a merchant built basis. So it's just a multifamily developer. They'll find the property, get the permit built, find a joint venture equity partner, and they'll go in and build a deal, get it leased up, and hopefully sell it right after they lease it up for a profit. And then they take their profits and do it over and over and over again. So, like, Alliance Residential, JPI, Travel Core Residential, those are some of the bigger ones in the Texas markets, Sunbelt markets. There's many merchant builders, big and small, across the country. But yeah, it's just build with expectations to sell for a profit, Paul, not hold.
So it's similar to like a single family builder. Some of the big names that the only thing they do is they build the single family homes, and Kaufman and Broad or Bloomfield Homes or whoever who's building that house, D.R. Horton, they're not going to live in the property. They're just building it for the person to come over and buy it.
Yeah,
And so
and D.R. Horton, for example, is a big builder of apartments as well. So they build, and they have a merchant model. They don't build to hold. They just want to flip out of it like they would a single family development.
that's correct. So what else are you seeing out there, Michael? I mean, you're kind of the eye of the storm of exactly what's going on. I mean, how do you describe the market if someone says, "Hey, listen, I know that you just pushed out a third quarter, about to push out
Newsletter.
your
Yeah.
newsletter. What are some of the highlights and points that you've made in that newsletter?"
Yeah, it's been a summer, so we've had a couple refinances we're getting through as we recorded. I'm in the middle of getting the closing statement together on a refinance. We're closing tomorrow. It's actually going to be a small cash out, which is great. It's a deal that we had to cash in a few years ago, and loan maturities at the end. So now we're cashing out a little bit of money. So not a tremendous amount, but directionally positive. So I will take that as a massive win, to be honest with you, Paul. So it's been good. And the debt market, it's all over the place, right? So what you're seeing in real time is you're starting to see some real capitulation with guys who just kind of in the rope. The lenders are not like playing ball. They're forcing the reality to be recognized after a few years of not recognizing it. So, it's really kind of workforce housing is kind of the center of the bullseye for distress. So this the 70s, 60s, 70s, 80s over levered deals from 21, 22. That's kind of like your center of the bullseye here. Syndication, craze, so all that 0% interest rate. Those checks are all coming due. So, as we kind of just alluded to, in a lot of cases, equity is, almost every case, equity is certainly impaired, if not completely wiped away. And then now, in a lot of the cases, these are even below debt basis. So you're seeing those things kind of come up and down. So so there's a lot of that. At the same time, we have syndicated a lot of deals. That's so my preferred way. We actually got awarded a deal that we're going to bring out for investment via syndication here after Labor Day. So we're still pretty active in that. But we also have done some deals with some institutional equity partners as well. They don't really play, or they aren't playing right now in the older space, but they're all kind of looking for like new construction discount to replacement costs. They want, that's the narrative that every one of them wants to go out and buy. Let's buy a brand new, 2 3 year old product at a discount to replacement cost. But then the reality of it is not very many of them actually want to put money out. They just all want to say they're going to put money out. So we're seeing a lot of like kind of silent no's, Paul. They're just like, you go show them this deal, then they go underwrite it, then they, beat you up on every single little assumption where they make it, where the deal has to be absolutely perfect for them to potentially get a yes. So they're essentially at the end of the day come say, oh, I can't do it because of X, Y, Z. And they kind of move the goalpost on you a little bit where they get so conservative that none of these deals are going to work. But at the same time, like I mentioned, refinancing a couple of deals. The equity market is tough, but the debt market is extremely robust and liquid. So it's not only just Fannie and Freddie, you're both very active. Bridge debt, Life Co, bank, they're all kind of throwing money, and these spreads are historically pretty tight. So you could get equity. It's really hard to get equity, but you get debt on, almost anything. So debt's extremely accretive, especially if you own a little nicer stuff. If it's a tougher, older deal, it's probably quite a bit harder to get debt. So I'm not, if it's the don't want you type of property or location. So that's tough. So you're just kind of seeing these deals kind of rebound, but at the same time, juxtapose operations. We're coming out of the summer right now. We're in August as we record this, but leasing season. We're at the very tail end of leasing season, and we're starting to really see fundamentals firm up. So in Dallas Fort Worth, as of a few weeks ago, for the first time since the first quarter of 2023, 100% of our properties were 90% or higher from a physical occupancy standpoint. So, in over 3 years, it's been since we had seen, probably almost 3.5 years since we've seen that in Dallas Fort Worth and our 20 assets we own in DFW. And as we are sitting right now, I think where the portfolio wide average is 95, with a 30-day trend north of 95 and a 60-day trend north of 93, I think it is, as we record this right now. So if I do nothing and just have the scheduled move and scheduled move outs for the next 60 days, I'll be 93% or higher on average. And then you're seeing that down in Central Texas is a little tougher, but even in San Antonio, we're seeing that. I think we're 94 across the board, 95 30-day trend and 93 60-day trend. And then Austin's been, beaten up pretty bad. But you're seeing that even there, our average, we're like 90, about 91 physical average. And I think we're going to pick up a couple points in the next month or two. And we have a 60-day trend of 90 as well. So, even those are getting much, much less bad. And, I kind of follow Jay Parsons, and he's kind of talking about like everyone talks about the supply and the wave of supply that we've had, but people don't talk as much about the absorption. So looking at a recent chart he put out, Dallas Fort Worth for the first half of 2026, we absorbed almost 20,000 units in Dallas Fort Worth. Number one in the country by far. Number two was New York City, which was less than 14,000 units. So, we're almost 7,000 units more absorbed in Dallas Fort Worth and in New York City. And then Austin, San Antonio also absorbed quite a bit of units as well, with over 5,000 absorbed the first half of San Antonio and about almost 9,000 in Austin absorbed. So they've delivered a lot, but we're absorbing a lot. And we're starting to see, rent, fundamentals prove up, rents, concessions should go away, rents are going to start to grow. So we kind of at this moment in time where I'm looking at it, Paul, where you have, investor sentiment is, terrible. I don't know what's worse than terrible, but it's about as bad as I felt since probably '09 or 10. Everyone you talk to in our industry is depressed. No one's making money. No one's made money for 3 or 4 years. People, they're in these workforce housing syndicated deals from the peak, have lost money or are afraid they're about to lose money in these deals. But we're seeing fundamentals firm up in real time. Valuations are such that they're pretty attractive, and lenders are forcing people to meet the market in real time. So it kind of feels like, it's hard to like call a bottom, ring the bell at the bottom. But I'm kind of think you should ring the bell. Like it kind of feels like the bottom's, now-ish, right? Or maybe we're even off bottom on the nicer, newer stuff, and the bottom's kind of forming right now on the workforce housing space. So, I mean, I've been saying this for a minute. It feels like a hell of a good time to be buying a lot of this stuff, and we're going to really try to lead in and do as much as we can.
In multifamily, they don't ring a bell at the bottom, do they?
They don't, but I mean, if I had one, I might ring it. It kind of feels like it. You're seeing these fundamentals firm up in real time, like occupancy's full. We're seeing insurance has had, after 4 or 5 years of large increases, the last 2 years seen decreases. Property taxes are getting reset in real time. The inflation pressure on payroll and R&M and all these other things have subsided. It's not like going back down, but it's not going up at the same pace. And we're seeing occupancies and everything kind of firm up. So now we need to see the rent growth kind of follow through and concessions burn away. But, feeling like it's kind of getting set up for that moment where we should, see growth, and you're seeing these values get reset in a major way. So,
Would you
I
would you
can't
call it
guarantee anything, but it feels pretty good.
would you call it that what you're seeing here is able to buy these properties because of the lost decade?
Yeah, yeah, I forgot to say that too. Yeah, so we're looking at these deals. So we're buying. We're in escrow to buy a deal in a high quality northern Austin suburb. It's late 2000s vintage, almost early teens vintage, and it last traded very beginning of 2016. And we are sitting here looking at it. And we're going to pay basically the exact same price that the seller bought it 10 years ago in 2016, 10 years later for the same price. So it's kind of like a lost decade. And I'm looking at this deal. I'm hoping to get awarded another deal and workforce housing deal in northern Dallas suburb. And the deal traded is it's going to trade for the exact same price as 2016. The only difference was it traded in, I think, 19 and then traded in 22 along the way. And this is going to be a full equity white for the investor, and then a pretty substantial, I think it's 25 to 30% lender loss to their debt basis, kind of in between. So,
Wow, that's huge.
but
That's a
you're just looking at it like, all these deals are the vintage deals from 2016. I mean, all those guys made a bajillion dollars on them, and I'm staring at the same pricing today as what 2016 was, and it's not like one or two deals. It's maybe not the whole market, but you're seeing like this is not like an uncommon thing here, Paul. You can replicate that, over and over and over again for at least a period of time. So I don't know how long the window's open, but right now it's like, rolling back pricing 10 years.
So, the market has done fantastic in terms of the stock market, not the investing market for the last couple of years, but the stock market has done real well. And a lot of people have a lot of equity that's exposed to the market. I mean, how do you convince some of these people that have their money in stocks to bring it over to multifamily? Just give me one or two things that maybe people not on this call, but maybe their spouses would want to hear just to give a sense of why to invest in a hard asset.
Well, hopefully the old capital accelerator will help that pitch, but but until you get that widespread news spread, Paul. I mean, I think it's really, again, it's a moment in time where you're seeing pricing roll back a whole decade. I don't know where the stock market S&P 500 was 10 years ago, but I mean, obviously quite a bit lower than where it sits right now. So from objective valuation, is it better to invest when the prices are higher or the prices are lower? And we've seen, we saw a hell of a 10-year run. The first 10 years I was in as sponsor, in the last 4 years or so I've been challenged. But trees don't grow to the sky, but then at some point they just don't fall forever either. So you've seen a massive reset in the fundamentals and the rents. We're seeing, like I said, kind of firming up. So it feels like fundamentals are firming in real time. Pricing has been reset. People are recognizing the reset. You have an abundant amount of liquidity in the debt market. It's just, can you get the equity or can you not get the equity? That's really the hard part. And trying to convince someone to buy something on sale is what you have to do. So, that, I mean, you get the bonus appreciations back, so the massive tax advantages, especially if the deal's kind of second half of the year kind of deal. You get a lot of investors that are like, I invest money in October and I get a K1 in January, February that has, 80% of whatever I invested in a year one tax loss due to the bonus depreciation we get. And I get to offset all these capital gains on my SpaceX IPO stock that I made a bunch of money on, and things like that. So some real good tax advantages, and starting to see some actual real yield in these deals, Paul. I mean, these cap rates have moved, especially in the workforce housing space, have kind of reset where there's a real spread between Class A, Class B, and Class C, like there should be, and like there wasn't 4 or 5 years ago. That spread is back in a real meaningful way. So you start to get paid for the risk of some of these older deals. So it's just kind of a moment in time that, those that have the courage of the convictions, I think will be rewarded. Again, no one rings about the bottom, but it feels like I think the bottom's been in on the Class A, and I think you're seeing the bottom be set on the workforce like in real time.
And you guys own a bunch of apartment buildings, but you guys haven't sold anything, or of course you haven't given anything back to the lenders or anything like that. But have you sold a distressed asset? Have you? Because I can't recall, but maybe you can comment on what you've sold in the last year or
Yeah,
two.
no, yeah, we've been fortunate enough to make money on all these deals. We were in one deal with another guy that we had 1031 twice and bought a deal at the peak that we had to sell a little below the purchase price. But that was one deal, and I was in control. We were just kind of along for the ride, but don't disagree with the decision. But yeah, no, but fortunately we have not had to. Not saying that listen, everyone that's been doing deals has certain amounts of problems that you're kind of fighting through, but I feel blessed on a relative basis to a lot of the peers. I mean, not to name names, but you see, headline after headline and the real deal and all the biz now and all the various, real estate trades that, a lot of pretty well known sponsors that were super aggressive, especially the workforce housing space. Unfortunately, they're having to take their licks right now in real time, and we're much better off, and we sold a whole bunch of deals as the market was going up, so we were able to kind of trade up in quality. So our portfolio that we have in place today is in much better, younger vintage, better locations, things like that. And we just didn't get super over levered on deals as we were going. So we certainly have our issues we got to fight through, but we're getting up and down. Like I said, I had a couple of refis, getting through them all, getting the cash out on them, getting neutral on the other one. So I mean, I'm feeling pretty good about our ability to kind of navigate, so far, and I'm starting to see the fundamentals firm up. So I think there's a backside to all this too, and I think it's going to be a few years of pretty strong fundamentals in the multifamily space.
And if people wanted to get a copy of your newsletter and probably maybe learn more about what SPI does, what's the best way to get in contact with you? And tell us a little bit again what SPI does.
Yeah, really, we're predominantly focused on acquiring high quality opportunities in the Texas markets. We don't focus, we don't play in Houston, but the other three majors in Texas, but really kind of have been right now to Dallas and Austin. Those were kind of really the better of the two markets in my view. Certainly a lot of opportunity and the basis reset of Austin with all the supply they deliver down there. You're starting to see some pretty attractive opportunities. If you want to find out more information, get into our database to receive the newsletters or get some information about our investment offerings. The best way is our website, which is spiadvisory.com. There's a contact form. You fill that out, and we can get you in the database and send that stuff. So again, that's www.spiadvisory.com. Hit the contact form, and we'll get you that. And like I said, we're expecting to have at least two offerings between now and the end of the year. I'm hoping to have the first one out shortly after Labor Day, and then hopefully, if we get fortunate enough to win this other deal, we'll have one out shortly after that. Both those with good bonus appreciations, massive basis reset, and we think some pretty good opportunity to capture some upside with pretty good risk adjusted returns here.
Michael Becker has a number of rules, and everybody remembers Michael Becker's rule number one: don't buy in the hood. So I use that all the time. But Michael Becker's rule number two is this business is unfair. And let's leave that comment to Michael to answer. Really, why is it unfair? Why can you go out and buy these deals that a lot of these groups cannot buy to get the pricing that you guys get, whether it's the loan or the sales price of the property? How can you
Yeah, I
do
mean,
it
I think right,
that nobody
right,
else
right
can?
now, I mean, all of these deals we're looking at in real time are just the seller and the broker are looking for certainty. So having a long, successful track record of certain, getting this done and doing what you say you're gonna do, and being able to speak with some confidence that you can, have this equity, you have this debt in place, this is how you're gonna get the deal done, and having the credibility to believe what the hell you're saying. You're getting these deals go awarded to you over the next guy, and it's just, it's an accumulation of things, Paul. I'm about to be 48 years old next month, and 20 plus. I mean, God, geez, I guess I'm 25 years in a real professional career here between banking and multifamily ownership at this point. Can't believe it's been that long, but I guess I guess it is at this point. And it's just like I find myself in these positions where something I did 10 years ago that, was a nothing thing. I went to some conference, I spoke at this event. I went on this boondoggle. I met this guy, I helped him out with the referral on a vendor, whatever that thing is I did 10 years ago is coming back today. And I'm in a tight situation where it's me or the next guy, and there's a jump ball. And then me doing that thing 10 years ago then comes and pays off. And I win that jump ball and I get to tip the deal over the next guy, and it's just all those things that makes it a completely unfair business for those that are new entrants into the marketplace versus someone like myself. So, I try to take advantage of getting my unfair share of deal and deal flow. And I think
And
that's
you
a
guys
lot of
are
it.
and you guys are probably not the first buyer to go to. You're the third or fourth buyer. Tell me what that means before we say
You
goodbye.
know, I'm frustrated the last few years just with these brokers throwing, pricing guidance out. You're like, man, this is 20% overpriced. Like, and so then you don't spend time on it. And then maybe someone buys it at a lower price. So really for the last 12 to 18 months, Paul, I kind of don't care what the broker says. I mean, I always ask for pricing guidance, but if it's a wildly overpriced deal, I don't spend much time on it. We do basic underwriting. I throw an LOI in, and then, if they pick a different buyer, then that's great. I'm just putting lines in the water because you're seeing all these deals get awarded, and then ultimately something happens along the way, the deal blows out, and they got to go to a backup group. So if you don't have a sheet of paper with a LOI on it, you're likely not to get a phone call when there's a rebound opportunity. So we've been for 18 months just putting lines in the water, and offering on these deals. And this deal I'm hoping to win in a northern Dallas suburb is that exact scenario where something I just put an LOI in, they went with another group, that group fell out, and I'm sitting here, and then I have a personal relationship with the seller. They're not local from out of town. I went on some real estate, cruises with the seller 3 years in a row, and got to spend time with him and his wife and their people and all this stuff. And here we are, and it's gonna, I think, hopefully, knock on wood, tip my way from just that whole accumulation of things and just being patient, and the broker guiding a ridiculous price, and it's going to trade at substantially below where pricing guidance is. So it's a very nuanced business, and there's a lot of things to it. But don't be a jerk is probably another rule to be a good guy, be well liked, and all those things. All those things
All right,
is
let me write that down. Don't be a jerk. That's number three or four. I always forget.
yeah, that's right. Don't be a jerk. Don't buy on the hood. That's the other thing. The deals that are really, really distressed, the deals that are kind of no bid right now, or the deals that are, very large unit count, have unattractive characteristics like aluminum wiring, or a chiller, or they're located in the high crime area. So if you have a 500 unit deal in a high crime area with aluminum wiring or a chiller, it's kind of no bid. And to clear that deal, it's going to have to get it really, really cheap. And someone's going to have to buy, like, just on a absolute no-brainer price to then move that battleship over a couple years. People all say they want distress until they actually see what a 50% occupied building is and how much work and effort and crime and all the other stuff you have to do to turn that place around. There's not it's not like buying a stock, man. It's a problem business. There's always a problem, and you got to kind of work through it. It's a very physical business too, both with people and with the physical, condition of the asset and all the myriad of things that go wrong. That's kind of what why I have a job, I guess, Paul, is all those things and dealing with other people's problems.
So again, thank you, Michael Becker. Again, we're not calling it the Michael Becker Show, but on Ask Mike Mondays, we certainly appreciate Michael coming on, spending some time with us, and giving us some facts and figures and some knowledge from the point of the spear of what SPI does here in North Texas. So again, Michael Becker, thank you very much. Appreciate it. I'm Paul Peebles. Have a good day.